He is back. Markets once again focused on what might come out of the mouth of Fed Chair Jerome Powell, and they seem to be getting cold feet around the concern that whatever that is, they're not going to like it. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive, and we are going to take a look at what it is that they seem so spooked by, which is not to say that markets are falling, but they certainly aren't rising, and nothing seems to have happened to really diminish their enthusiasm other than what the Fed chair could tell them. And so that really is where we'll begin. What was it that got them so happy about the Fed's message last week? And why all of a sudden are we concerned about what the Fed might say next when it seems like everything is going the market's way? Let's start with what did the Fed tell markets? And as we can see here, the path forward is very dovish indeed. Looking at Fed policy expectations for next year, notice this adjustment. Rates at the time that the Fed made this determination were 5.3 on average. That's the midpoint in the 5.25 to 5.5 range from which the Fed began its rate cut cycle. And we can see that in June, there was only one cut seen from 5.3 to 5.1. In this most recent update, it's 100 basis points. That, of course, implies that the Fed is going to, in addition to the 50 basis point cut they already delivered last week, cut by 50 basis points more spread over the next meetings in November and December. In other words, there's another 50 basis points in the chamber before year end. For next year, the move is seen from 4.4 to 3.4. So another 100 basis points or one full percentage point locked in for next year. Take a look at what this has done with market expectations for where Fed policy is going. And what we see is it hasn't changed them all that much. In the gray is the outlook for this year. This is what's baked into Fed funds futures. In the yellow is the same for next year. This here is the sum. Notice it is 175 basis points between now and the end of next year. So it's a little bit on the heavy side of what the markets are at this point expecting relative to Fed policy expectations. But notice it hasn't shifted around all that much since the Fed made its announcement. In fact, it's been sort of stuck in this range of about 2% to 1 3/4. And if we look at how this lines up with the Fed's outlook, we see that what the Fed essentially did was it endorsed market expectations. Looking at where we landed on September 18th when the Fed actually made its announcement, the Fed had 100 basis points in cuts for 2024. Fed funds futures had about the same. For next year, Fed fund futures are a little bit more dovish, 123 basis points. The Fed signaled 100, but because there is the benefit of time here, there's a long time horizon. This is the end of next year, after all. There's all kinds of time to come to terms on whether we need one rate cut more or one rate cut less. And so the markets really didn't seem to get overly stuck on this idea. What was the response? Well, here's the S&P 500 here to kind of get a general sense of overall risk sentiment. And we can see here, this red bar is the day of the Fed. Markets seem to digest it a little bit. There's an initial pop higher. Things then come back in. We close marginally lower as things digest. But the following day, there is an emphatic rally. And the interesting thing is we still are struggling to get back over its high. So there's not been follow through. But at least in the moment, what the market said was, oh, good. The Fed has given us exactly what we wanted. Maybe not all the way there for just 2025, but a difference of 20 basis points over the subsequent 18 months is really not a big deal. That is a level of dislocation that can be easily adjusted with incoming information. That's too far ahead to really be worried that this represents some sort of a meaningful misstep from the Fed. Most importantly, the Fed loudly endorsed the market's dovish disposition and very firmly told them that at least near term, it is going to deliver exactly what they'd already baked in, which perhaps explains a little bit why the markets have not continued to power higher. There really hasn't been a meaningful shift in expectations beyond this. The Fed has essentially endorsed market speculation. The market said, right, okay, good. But there's not been anything particularly new in this narrative. And so follow through has been somewhat slow, to put it mildly. And this is where things get a bit interesting. When the Fed came out with its dovish repositioning, the message from Chair Powell was, this is not an emergency. We are not cutting 50 basis points because we feel that something is wrong with the economy. We do not feel ourselves late on catching the downturn in growth. We think what we are doing in issuing this jumbo-sized cut is we are getting ahead of the curve. We are taking out insurance that we're not going to fall behind because we see the labor market cooling. We see that it's time to cut. We don't want to be late. We don't think we are late. We want to make sure. But the economy is fine. It's strong. Everything's okay. And the markets read it as such. They ultimately take the Fed at face value. Not only does that help to explain why the day after the policy announcement, the markets surge, but if we look at the way that things have repositioned, we can see that the markets are betting on inflation. And that, of course, would make sense. If the Fed is going to be successful at engineering this soft landing, then we're going to get back into a reacceleration of economic growth thanks to this stimulus. If we are, in fact, 50 basis points into a rate cut cycle that will give us somewhere between 175 and 200 basis points in easing between now and the end of next year, that easing coming on top of an economy that's not doing poorly will probably mean that inflation starts to tick back up. Because what this stimulus will do is ramp up economic activity in an economy that isn't struggling to find that activity at the moment. So what this will mean is more demand, and that extra demand will put upward pressure on inflation. That is exactly what we see all across financial markets. First, at the top here, I'll look at break-even rates. These are the inflation expectations that are implied in the bond market. So if we look at the difference between the nominal 5-year yield, say, and then the inflation-adjusted one, the 5-year TIPS yield, we can take the difference between those two and end up with what that inflation adjustment is, how you go from nominal and end up at real. And so that implies what the market is benchmarking as inflation at a 5-year window. And if we look here, and that's the break-even rate. And if you look at here, 5-year break-even rate, 10-year break-even rate, the 20-year break-even rate. First of all of them are running above 2%. Second of all of them are back to levels unseen since early June, maybe a little bit less dramatic in the longer term one here, back to levels unseen since mid-August. But of course, this is a much steadier and longer term perspective when you go out a full 20 years. The 10-year, though, the 5-year, significantly higher here. And of course, overall inflation expectations significantly higher. The same story in gold. One of the key things that makes gold attractive, of course, is as a hedge against inflation. And so as rates come down, the appeal of an asset that benefits in this kind of an environment, needless to say, rises. So as inflation expectations go up, you get a further push higher in gold. It is now at a record high. You also get a further steepening of the yield curve. This right here is the 10 to 2-year yield spread. And what you see here is the kind of steepening that anticipates higher rates in the future as a response, of course, to higher inflation. Interest rates are rising significantly at the long end of the curve, even as they are a little bit more anemic at the front end. Not surprisingly, of course, the Fed is currently cutting at the front end. But the expectation is that this cutting will unleash inflation and that this inflation will beckon higher rates. In other words, that the floor currently on rates is rising. And the depth of rate cuts is going to be hamstrung because we are delivering stimulus on top of an economy that isn't struggling for growth. So reflation isn't a welcome sign of recovery. It is a heating up of an economy that's already doing okay. We saw as much, incidentally, in Purchasing Manager Index data that we got earlier this week. We can see here for the 4th consecutive month now, overall U.S. growth hovering near this 1-year high that was set in May. So here's May of last year. This right here is May of this year. So we can see this surge in growth in May gave us a 12-month high on the growth rate for the overall economy. And that's as services look fairly well supported, offsetting this slump in manufacturing. Of course, as ever, in the logic of PMIs, 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And so you can see here, manufacturing is contracting at this point at an accelerating speed, but services isn't so much accelerating very much, but it is holding up at growth levels unseen in a year, and is doing that for 4 months running now. That, of course, because services is a much bigger component of the overall economy than manufacturing is, that is creating this resilience. That's why when you pour stimulus on this economy, inflation expectations bubble, not surprisingly. The Atlanta Fed's GDP growth now model, or GDP now growth model, implies something similar. We can see here this compares very favorably with what it extracts as consensus growth expectations. It looks like it sees a range of somewhere around 2 to 2.5% for consensus and about 3% where incoming data is suggesting we might actually end up on third quarter GDP growth. So, needless to say, the story on growth looks relatively well supported, and yet we have all of this aggressive stimulating that still looks to be not only in the market's mind, but endorsed by the Fed for the most part. This is what makes for the precarious situation where we find ourselves in now, and perhaps why the markets are a little bit gun shy right here. We have a speech coming up from Fed Chair Powell over the next 24 hours. He's going to be giving the intro remarks at a conference being hosted by the Fed branch in New York, the U.S. Treasury Market Conference. Seemingly a mundane sort of outing. In fact, it looks like he's not even going to make the remarks live. It looks like it'll be a pre-recorded message to kick off the conference. So there is seemingly not a tremendous policy steering opportunity here, at least in the formal sense. Nevertheless, it is no doubt obvious to Fed officials that what has happened since they have moved on rates has looked like expectations of reflation, from what's going on in the break-evens to what's going on in gold to what's going on in the yield curve. And with that in mind, there seems to be an opportunity to make sure inflation expectations stay in check. We heard from all manner of market participants that the Fed's action implies that they've declared victory over inflation. The Fed, of course, would not use such language and didn't when Powell was questioned directly on this after the FOMC announcement. And this perhaps is an opportunity for them to remake that point, just to make sure that as they cut, there is a level of two-way risk here whereby the markets don't go, well, the Fed is on autopilot. That's it. And they may well be on autopilot for November and December. But if Fed Chair Powell attempts in his remarks to give a nod to the idea that inflation expectations anticipate this melt up, but the Fed is not looking the other way, that the Fed is still very much minded to bring inflation back on target, that it sees that we've oscillated back above the key 2% level here, that everywhere in the market is screaming that inflation will reaccelerate. It is perhaps here that there is an opportunity to kind of push back and say, hold on. If inflation does reaccelerate to this extent, we are not beyond action. We don't think we're out of the woods. We're not on a predetermined course. And that might start to make the tally of rate cuts on the menu for next year start to appear a bit heavy if inflation expectations continue to rise. And if that's the case, markets might well get a little bit soft-footed here. That perhaps explains this reluctance to keep going. Now, that does not necessarily mean that we're looking to fall, or that the risk is down, or that the price action is suggesting that a reversal is already underway. No. But we do have what seems to be a lack of follow-through beyond the post-Fed high now for 4 days. And if the message from the Fed isn't there is more dovishness yet, in fact, if it is relatively optimistic on growth, as the Fed has been, then reflation is the order of the day. The markets have made that clear in the way that they've set up here. And if that threatens the Fed's balance of risks, well, then it's only right that the Fed push back. It does have a dual mandate. It's not going to reverse cuts or signal that no more cuts are coming. That's much too drastic of a term. But it might certainly float the idea out there that nothing is on a predetermined path, and that if the Fed feels like inflation expectations are running away from where it wants them to be, anchored firmly on this 2% in the medium term objective, then it need not cut at the pace that is now anticipated. It could go slower. It could cut less. And so the range of risks here seems to be not that the Fed says something even more dovish, it's that the Fed says something that dilutes confidence in how much dovishness there is to be had that is already priced into the markets. And so we can see in the market's reluctance, they are perhaps done with their pricing in of what's there, and the surprise risk for what's next isn't in a more dovish direction. At least you could get that, but the risk of it is not as pronounced, it seems, as the risk of the alternative. And that appears to create some downside risk in stocks. It seems to create some upside risk in bonds, and may well give a leg up for the US dollar as perhaps some rate cut expectations are factored out for next year and yield differentials move a bit in the dollar's favor. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what may follow thereafter. Just 30 minutes from the show today and every Wednesday, I'm on with Victor Jones for the Price of Truth. So definitely come and check that out. I'm back with Chris for Futures Power Hour on Friday, on with Victor and Tom for First Call on Sundays, writing for the news and insights portion of tastylive.com, and commenting on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money is back tomorrow.